Well, good morning, everyone. Good morning, everyone. It is June 29th, Monday, June 29th. It is so good to see you all this beautiful and awesome Monday morning. Awesome in Austin. I'm going to combine the two words. Happy to be here with you all. As you know, we were not supposed to have this meeting this morning, but I was able to get back to good old America late last night. I was able to rebook my flight. A flight opened up that, I landed at 2:30 a.m. So landed at 2:30. Well, no, we landed like around 2:10. So we got home like at 2:30, 2:45 and got up at 4. So here we have it. So there we have it. I was supposed to fly in today from Toronto, but thankfully we were able to leave yesterday, and I am happy to report that the kiddos team was the only U.S. team to make it to the semifinals, and we actually made it to the finals. So we got second place, and now this is the biggest 2011 birth year tournament really in the world. So it was really exciting to be there. Lots of games, 8 games in 5 days, which is absolutely insane. But unfortunately, we were not able to bring in the gold. Team Ontario, Canada kept the gold, so that was a little bit unfortunate. But you know what? Second place, we'll take that. But it is very, very good to be back. It's very good to be paying these. Y'all, I'll never complain about gas prices again. I'll never complain about food prices again. Oh my goodness. How do people live in Canada? Y'all couldn't believe it. The kiddo likes IHOP, right? And we went to IHOP, just the three of us. Y'all, it was $126 Canadian dollars, but it's 126 Canadian dollars. I'll never complain about prices here ever again. Gas prices, I will never complain again. Unbelievable. It is so good to see you all this beautiful Monday morning. Want to remind you all that we do not have a meeting on Friday because it is July 3rd. ABOR is going to be closed in preparation for our 250th anniversary, which is super exciting. But July 4th, and did y'all see the heat wave that the Northeast is experiencing? And then Europe, I mean, y'all, it's like Europe, and they don't have AC. I mean, oh my goodness, I cannot imagine living without air conditioning when it gets that hot. I mean, I saw pictures of like traffic lights melting in Germany. It's unbelievable. I mean, people are dying by the thousands. And then apparently up in the Northeast, I mean, Chicago's going to get up to 104 degrees. Now for us, we're like, oh, whatever. What are you complaining about? But we're used to that. I mean, our homes are built for that. Their homes are not built for that. I'll say that much. So pretty crazy what's going on. But it is July 4th on Saturday, which is super exciting. Hopefully you all will celebrate well. But what we're going to do is we have our amazing Monday morning touch point where we update the single best leading market indicator for the entire Austin area. And that's the new listing to pending ratio. I'm going to give you a breakdown of what that means. Before we do that, though, I do want to share with you the highlights of this week for the economic calendar in what may be affecting rates this week. What will be affecting rates this week? We are going to start off, let me get rid of that. We're going to start off this morning. We've got the Dallas Fed Manufacturing Index came in flat, 0. We got some auctions going on in 20 minutes. Tomorrow, this is going to be a pretty decent day for us, big day for us in real estate. This is when the Standard & Poor's Housing Composite Index comes out. When this comes out, we are going to be able to update our National Market Index. When you go to Insight and Statistics, or when you go to the Team Price Austin Metrics app, and you go down towards macroeconomic data, we have two components that we update: the Freddie Mac House Price Index and then the National Market Index. National Market Index was updated actually 2 weeks ago, so we're going to be updating the Freddie Mac House Price Index, where we track the activity for the top 40 cities and then also all of the cities that are tracked by Freddie Mac. So that's going to be available tomorrow at 8 a.m. As soon as it's posted, I'll go ahead and update those resources for you. Keep in mind that that is a lagging market indicator. The reading for that is going to be for the month of April. So they're going to publish April's reading, which is the average of February, March, and April. So they publish in June the reading for April that averages February, March, and April. Big lagging indicator. Historically very accurate, but it tells us what happened from February to April, or really February to March. So we can't trust that. And it's, as a historical rear view mirror, it's great, highly accurate, very reliable. They use like properties. They go all the way back to 1975. It's a great index, a great reading. This is the reading that usually makes the headlines. It's going to show that prices are down. And now I'm going to show you what's going on here in the month of June, which is shocking what's happening with pricing in the Austin area for the month of June. We've been calling that because pendings are up double-digit year over year. The data that we have now for the month of June so far, based on current demand, is not going to line up with the headlines, because the headlines are for April going back 3 months, the average of 3 months. Well, what was February like? What was March like? A little bit on the softer side of things. So we have to be aware of that. But that's going to make the headlines. Our data is not going to make the headlines. The national, the Freddie Mac data is going to make the headlines. So we've got to understand the difference between the two so that when a client asks the question, we can address it, because we've got some pockets right now within the Austin area that are just killing it, doing very well. But then your client opens up the Wall Street Journal and they're like, whoa, look at Austin. Hit another low. Well, yeah, that's because they averaged February, March, and April. They're using that lagging indicator. Your client's looking to put an offer on a 78739 zip code home. They're going to have to go over list price. So you've got to be able to articulate and explain that to your client when they're asking. We've got job data coming out. JOLT stands for job opening labor turnover. How many quits? How many hires? How many voluntary quits? How many forced quits? Then going into Wednesday, we've got more manufacturing data, some additional payroll data, mortgage applications, some commodity data. Going into Thursday, that's going to be the big day, because that's going to show us the health of the economy related to employment. What's the non-farm? What's the overall employment rate? That's going to be on Thursday. And from there, we're just going to pause. We've got a little bit of commodity data coming out, but look at that. Friday, that's going to be a holiday. That's why we don't have a meeting. It's a holiday. Friday, July 3rd, a holiday. Little bit of commodity data coming out, nothing that's going to impact the market. Most of the market will be impacted. They're not going to care about the real estate data. The mortgage market doesn't care about that. What's going to impact the market more than anything is going to be the data out on Thursday. And then we're off Friday. Then we're going to regroup on Monday to see how the bond market adjusts to whatever happens on Thursday. But if you look behind me at the 10-year Treasury, we can see that over the past 5 days, we've had a really good run. We've crossed 2 repricing lines over the past 5 days, and we are holding steady on the 10-year over the past 3 days. Robert sent over the rate sheet. Let me go ahead and pull this up so I can show you what is going on. And we're still at 6.5% for the 30 years, 6.5% for the 30 year, 6 1/8 for conventional 15 year, exactly 6. Now that's the exciting part. FHA, VA, USDA holding at 6, which is really good. Buyers move when it gets to that 6. So we've had a good 3 days. On the jumbo 30 year, only 6 1/4, which is really good. And then on investor 30 year, 25% down with an additional point. You're looking at a fairly reasonable 7, only 50 basis points higher than the 30-year fix. So on the investor side of things, not bad. Not bad at all. So that's what's going on this week with rates. What do you think my recommendation is if a client wants to hedge the Thursday data dump? Lock and float. Lock and float has been my recommendation for years at this point. It makes sense to lock and float. The market is highly volatile. And it just always makes sense. Well, what does lock and float mean? Well, it really depends on the lender. Number one is you've got to be talking to a lender that offers that product where you can lock in the rate today. And then if the rate floats down between now and whenever we have to close on the loan or get through underwriting, you can float the rate down. Some lenders require a repricing of 25 basis points. Other lenders are going to require repricing of 1/8, right? So either a quarter or 1/8. Well, what does that mean? So let's just say you lock in right now at 6.5. Some lenders require that the rate go down to 6.25 before you can float it down. Other lenders will say, no, as long as it goes down 1/8, 6.375, we're good. So have that conversation with the lender that your client is using. You know my recommendation, Robert. I mean, in my opinion, your opinion, our client's opinion, he's absolutely fantastic. And what I like about Robert is that he's got a product that he can pick the date that had the best rate and then go backwards in time and lock in on that rate. So give him a call, reach out to him, have that conversation with him. But I recommend locking and floating, especially with the unpredictable nature of data that's getting released here every single week. Now we're going to update the famous new listing to pending ratio. Well, what the heck is this? Very simple, very effective. We take new listings on the market and then we take back on the market. We're looking for new inventory coming into the market. And then we divide that by the active under contract plus the pending. And that's the absorption of buyers. What are they absorbing from the existing pool of inventory? And that's going to give us this ratio. So if you have 1,000 listings coming into the market, combination of new and back on the market, and then you've got 1,000 listings that are being absorbed by the market, you've got a ratio of 1.0. That's going to be that perfect market equilibrium. Inventory neither goes up or down because the same number of properties are being absorbed that came into the market. When the ratio is under 1, well, then you do have a buildup in inventory because 1,000 new listings come on the market and let's just say 600 are absorbed. Well, that's a 0.60 ratio. And this green and red dot gives us an instant snapshot of whether this week's ratio underperformed or outperformed last year. So you can see that last week, which was really 2 weeks ago, from June 15th to the 26th, the ratio came in at 0.71. It's red because it's slightly underperforming the 0.71 from a year ago. That's because it's a rounding, right? At the end of the day, this number comes out to 0.711123, right? It just kind of goes on in borderline infinity. So we're slightly underperforming because of the red, which means that we're going to overperform. That's the good news. The good news is that 3 weeks ago, we overperformed. We came in at 0.73, 0.70. That was a reversal that happened this last week because we had all reds. We had 3 weeks of reds. Now we've got green. We're going to have green right here. So we did break that trend. We were at 14 weeks where the new listing to pending ratio was outperforming the previous year. We hit a red right there. That's going to stay red. There's no way we're going to make up that gap from 0.66 to 0.69. But now the good news is that we're back on the green. So that's good news. We had a little bit of a pullback in demand in comparison to new inventory entering the market, expressed by the new listing to pending ratio, little bit of a pullback for 1 week, and now we're going to back on track. We're now overperforming last year. Keep in mind that this is for the 6-county area, and that is going to be Travis, Williamson, Caldwell, Burnett, Bastrop, and Hayes counties. So let's go ahead and go backwards in time a little bit from the 15th through the 22nd. And this is going to change to 587 because agents always update the under contract late. So we always have to go backwards in time to make sure that everything is updated. That goes up from the 8th to the 15th. This is going to be 492. From the 1st to the 8th, that's going to be 523, just by one, but we want to make sure the data is flawless and perfect. 573, let me just take a look at a few more weeks. 544 and 585 and 572. That's great. Now we can start updating this week. What we're going to do is we're going to go from the 22nd to the 29th. Another thing that I want to remind you all is that it is 10:22 a.m. New listings will continue to enter the market between now and 11:59 p.m. tonight. So when you receive this information, when you look at this information tomorrow morning, the price increase, the price drop, the back on the market will lock. It'll never change again. And then the active, under contract, and pending will continue to go up based on agents updating those listings. But as of now, we are looking at 1,147 new listings. Price increase, we're looking at 209. Price decrease, we're looking at, okay, interesting, 1745, 1745. Holding steady at 89%. A little bit of reversal from 2 weeks in a row that we got up to that 91%. Back on the market, we're at 240. Well, that goes up to 21%. We haven't seen a 21% back on the market. Oh, this is the highest one this entire year, you all. We have to go all the way back to December 29th through January 5th to get a back on the market percentage over 20%. Well, we got January 19th at exactly 21%. Now we bumped that back up to 21% back on the market. Okay, that's something interesting, something worth keeping a little bit of a mental note on. Why do we have such a high number of back on the market expressed as a percentage? That's really interesting, which is why I love contingency offers and backup contracts. Love backup contracts because look at that. You've got roughly from the start of the year until now, there is a 17% chance that the deal is going to fall through. 17% chance. I'll go to Vegas on those odds all day long. That's not bad. Then active under contract, 400. And now I need guesses. I need 5 brave souls to go ahead and guess how many pendings. Okay, Melanie's going to start us off with 203. 1 down, 4 to go. Seth coming in at 199. Seth is going for that under 200 mark. Charmaine coming in at 211. Carl coming in at 250. Good to have you here, Carl. Everyone say hi, Carl. Ryan coming in at 200. Bertina at 225. Okay, good stuff. 189, Brazil. Bertina said hi, Carl. Good stuff. Carl is taking his licensing exam and going to be a Team Price agent. So super excited to have you on board, Carl, and really, really exciting. And I'm telling you, he's going to kill it in real estate. I love it. And it's really exciting. And Carl also has the distinct, amazing pleasure of being married to my sister. So as my dear brother-in-law, I adore Carl. So welcome aboard, Carl. We've got... Let me click here. 1 starts with a 1. 1, 9, 7. 197. 197. Daniel wins because, who is it? Who had... Seth went over 197, so he kind of barely... Daniel wins, 189. 197, you all. Okay, so we're starting off the week at a 0.43 ratio. And let me take a look at what we started off the week last year on this ratio. I'm going to pull up the email that I sent you all with the summary of our Monday morning touch point. Let me go to that Monday recap. Monday recap email had us starting off the week. I want to say that it was over 0.43, wasn't it? I think it was over 0.43, but let me look at that email. We started off at 0.47. It was. So when we updated this information last year, we were at 0.47, or last week. Now we're at a 0.43. And the ratio last year was 0.74. It's going to be a tough one. That's going to be borderline on whether or not we outperform last year this same week. It's going to be a tough one. Now, take a look at the new listing and see what's happening here. Are we going to get 73 new listings coming on the market in the next 13 hours or so, 13 hours and 44 minutes? Are we going to get 73 additional listings come on the market in the next 13 hours? I don't think we will. And the reason I say that is because if I were a listing agent, I would just wait until like July 1st to list the property. I wouldn't list it right now, June 29th. So we're going to notice a pullback on the number of new listings entering the market simply because of the June 29th timeframe. We're going to get very close. We're going to get very close. It's going to shrink. I'd say we get about another 50 new listings entering the market between now and 11:59 p.m. tonight. We've had 56 more price increases, and we are now running 8 weeks in a row where price increases are higher than they were last year. 97% of those price increases are new construction. And we have 7 weeks in a row with less price drops. Healthier market. We've got less back on the market. And on the active under contract side, we have been plus. Apart from this week, we're down 169. But we've been plus on active under contract for 11 weeks in a row. On the pending side of things, it's fluctuating a little bit. This one, I'm very hopeful for this one. I think that some fool of an agent is going to go back and like, oh yeah, my property did go pending back in May 12th, and that's going to be a zero. So I've got confidence. Like we need that one agent just to be like, oh yeah, I am, 8 weeks late on updating my MLS. I did have that property go pending. I promise you that's going to happen. But look on how much we've been overperforming the new listing to pending ratio. If I ignore this week and I go all the way back to February, the new listing to pending ratio has outperformed last year by 9.9%. And what I like about this new listing to pending ratio, it's such a pure and simple formula. It's supply and demand. Everything is predicated on supply and demand. What is the incoming supply in comparison to the demand? And then how do we compare that to this time last year? So I can say with a very high degree of confidence, if I go all the way back to the beginning of the year, I can say that this market right now is outperforming last year's market by 8% based on this supply and demand metric. So way better market. I mean, 8% is a decent number. I'll take 8% all day long. Are we going to outperform last year where we had a 0.74 and a 0.43? We're down only 6% on new listings, but we're down 45.6% on properties under contract. It's going to be close. It's going to be very close. So we're down 41.9% on the ratio. Can we make up this gap? When you look at the number of pending properties, we are at 1,035. When we updated this same line, when we first updated this line last year, last week, 6/15, we were at 623. So we gained about 400 in 1 week. We're down 500. It's going to be really close. It's going to be very close. We're going to be positive. We're only off by 0.3%. We're only off by 3. This is going to go positive. Just give it another 3 to 4 days, and this is going to go positive. I would say, are we going to get another 500 properties that go under contract? Keep in mind, agents are really bad when it comes to updating the pending. I'd say 80% chance. There's an 80% chance we're going to go positive, which means this is going to go positive. No, this one won't. Let me go back to the comparison. Well, 17. No, we're not going to get 17. It's too far back. April 27th. Too far back for us to get 17 pendings. Totally. I mean, that one right there on the 3 is totally fine. We're going to get that one on the 3. Oh, no, this was 6-1. Let me go back. 6-1. Where is 6-1? Oh, yeah, we did beat it on the under contract, but that's why I like the ratio. Look at that. We had more properties under contract, but way more that came new on the market. That's why the ratio is negative. So, no, we're not going to go positive on this ratio. We're down by 3.4. We're not going to go positive. The reason why this ratio is positive, even though we have a -1, or this is positive, even though we've got a -1.3, is because new listings collapsed. We had this period of time, April into May, where the new listings entering the market just collapsed. I mean, go all the way back to March. All of a sudden, everyone stopped listing. And now we're seeing a little bit of a pickup right there on new listings entering the market, which is really interesting. A little bit of a delay reaction on people putting their homes on the market. It's like they just took time off back in March, April, into May. So 80% chance that we are going to beat out the same week last year. Let's update the monthly. Let's see what's going on monthly. Because over the past 4 weeks, we've been seeing some additional properties entering the market on new listing. So let's see how we compare. On the pending side, do I have to update anything? No, I don't. Let's go ahead and just start updating the month to date. New listing, 4780. And price increase, 725. Price decrease, over 5,000, 7,089. And let's go back. Back on the market, 844, 18%, highest one since January. Active under contract, 1958 active under contract, pending 1456. Yeah, still low, disappointingly low at a 0.61. Last June, 0.72. A little bit on the disappointing side on the month-to-date figure. Mainly because we are seeing way more new listings entering the market. Look, is that correct, you all? New listings, 4780? It is correct. Y'all, take a look at this. 4780 new listings. We still have 2 days left in the month. Wait, today and tomorrow, day and a half. And we've already beaten the year-over-year new listings by 5.3%. Price increase, we're already up by 70. Price drop, we're down by 2,101. That's a good metric right there. That shows us, yeah, the market hit its bottom. We're no longer seeing the price drops that we saw last year. We had just brutal. I mean, this was going back to 2021. That's when the price drops started happening, and then picked back up 2024 to 26. Prices hit bottom January 2025 because of all these price drops. Now we're noticing more price increases, less price drops. But new listings, I would say that we're going to get about another 75-ish or so new listings entering the market between now and tomorrow, at least 75 to 100. And we are already up by 241 new listings compared to June of last year, up 5.3%. Crazy. This number can't be right. You can't have something that's down by 100% or else it'd be zero. I have to check on that. What's going on here? Let me see. Did I update it? Oh, I know why. Sold. Let's take a look at the sold. Where's the sold? Oh, yeah, we haven't filled out the sold yet. There we go. I was like, what the heck is going on? Let me finish updating the withdrawn. That's going to be 883. And the expired. What's going on with expired? 259. So now that we have the sold information, let's compare everything. Active or new. Active, we're down 4.8. New, we're up 5.3. Pending, we're down 12.8. Sold, we're down 18.4. Could very well end the sold on the negative. That's going to be interesting to update this in the next 2 to 3 weeks. That could stay negative. We're going to go positive on pending. We're already positive on active. But the active is going to exceed the pending, which means that we are not going to beat that 0.72 ratio. It's going to be cooler than that 0.72 ratio. Inventory is going to expand at a higher rate for the month of June 2026 compared to June 2025, which was not the case April, May. Heck, it was not the case. Let's go here. November, December, since January. January, February, March, April, May. We've exceeded last year on the new listing to pending ratio. And there's that slowdown in June compared to June of 2026. There's that little bit of a pullback. Now, I do want to show you one other interesting thing that when I was updating this data, I was like, wow, is the leasing new listing to pending ratio. And let me make sure that you can actually see this. Leasing. Look what's happening with leasing. We're now getting less new inventory April, May, and June. New inventory in the leasing is starting to go negative. Things that are entering the market. And look at the pendings. Properties that are getting leased on the positive side of things. So there's that improvement that's happening even on the leasing side of things. So we are already at a 0.71 new listing to pending ratio for leasing. Last June was 0.69, 0.75 versus 0.68, 7.9 versus 7.2. So from April, May, and June, we're outperforming last year also on the new listing to pending ratio. So take a look at your email. You're going to receive the entire PDF of this analysis. And let us switch gear and talk about the market. We are now just 360 properties under the previous peak. Melanie said, can we add the monthly activity index chart for leases? I always wish we had that when I talk to landlords. So can you, like, what do you mean by that? Like the monthly activity index for leases, like which one?
The one that shows like the past, what is it, like 12 or 13 months? Like what the activity index is for that month, for that zip code or city.
For that, okay, I see what you're saying. So let me get that for you. This one. This one?
Yes.
But for leases?
Yes.
If I start now, then I would be able to have the 12 months from now, because what I have to do is I have to freeze the pending for the end of that month. And the reason we have it for the resales is because we've been keeping track of this for like 4 or 5 years, right? So we've got the entire historical on the activity index. Because I freeze the snapshot of, okay, on the 7722, how many properties do we have pending on leasing? And then I freeze that snapshot. So I don't freeze that snapshot right now on the leasing side of things. So I would have to start doing that. Send me an email and let me kind of look into that. And I'll happy to report back to you. But if I did start doing that, then it would, in essence, it would be data that would accumulate over time. And then a year from now, we would have the 12-month historical. But it is a perfect time to request that, because at the end of the month, the last day of the month, I just take that snapshot. Okay, this month, here's how many pending properties we had in this zip code, and then I freeze that, and I'm able to capture that historical data. But that's a good question. I'll definitely take a look at that. So we're down 360. Last year, the market peaked June 30th at 18,146. Right now, we're at 17,786. So we're 360 listings under the market peak of last year. And the big question that we have is, are we going to break the market peak? The momentum is showing that we are going to reach another market peak on active listings on the market. We're down by only 360. And over the past 4 weeks, including this week, we are going in that trajectory. Are we going to cross 20,000? Absolutely not. I mean, there's nothing that indicates that we're going to cross 20,000. We thought earlier this year and into last year that we would break that 20,000 mark. That ain't going to happen. That's not going to happen. Absolutely no way. And when you look at the permits that are being issued and have been issued, we are noticing, you all, a collapse on permitting, which is going to contribute towards a lack of housing 2-3 years from now. As the market works through this excess inventory that we still have, over 50,000 residential apartment units currently on the market on apartments.com. There's a lot of inventory out there. And then you look at the 17,000 active properties for sale, plenty of inventory. We are starting that process of builders saying, I'm not going to pull permits. I'm just going to work through this available inventory. And take a look how deep that correction is. Look at this figure. Some of these are shocking. All cumulative, meaning every single permit that was issued, single family, 2 to 4, multifamily, 5+, every permit issued from May to June, because that's the latest data that we have, we're looking at 8,273. That's a drop of 31.6% year over year. That's 17.3% below historical average going back 26 years. And how much of a drop is that from 23-21? I mean, that's a 70% drop. And that's everything. When we adjust this for population, we're down 32%. All units per 100,000 people. We're down 32% year over year. And we're down, once again, 70%. We're doing a third. We are issuing a third the number of permits that we did back in 2021. So we're not issuing enough permits right now simply based on population. But what we do have is this excess inventory that's going to be absorbed by the market, which is why we're seeing stability in pricing, both on the residential side and on the leasing side. When you look at the multifamily, this is going to shock you. Let that sink in. The multifamily market is down 90% from the peak. Let that sink in. The multifamily market, cumulative multifamily permits, down 90% from 2021. What do you think is going to happen in 2030? Well, we're going to lack leasing multifamily inventory simply based on migration. Even if migration slows down from 2.8 to 2.5%, we're still not going to have enough housing in 2029, which is going to lead to what? A speedier recovery, a compression of the recovery phase, and then a new market cycle. It's just a normal market cycle. Sonia said, and we will see a lot of new construction, and we still see a lot of new construction everywhere. So it will slow down in the next 2 to 3 years. Is that what you're saying? Yeah, absolutely. I mean, well, new construction is already slowing down. So what they're doing, Sonia, is the vertical projects that you're noticing is primarily coming from the 2024 and 25 years. That's where anything that's going vertical right now. So you've got a year worth of permit, site prep, and everything else. And then you kind of start going vertical. That project was pulled back in 2024-25. That's going vertical. So that's like that 4,000. This 11,000, that's fully built. That's in the market. That's part of that 50,000 active apartment units currently in the market. And now we're down 90% from that. And let me adjust it for population here so you can see. Look at this. Adjusted for population, we're down 71% year over year. And we're down 75% below the average. The average is what the market bears historically adjusted for population. So what this means is that for us to have a healthy multifamily market, we have to build roughly about 195, let's just call it 200 units, permits being issued cumulatively from January to May. If you want to go on the monthly side of things, we have about 40 per month. Give us 40 permits per month, and it's going to adjust for population. On the cumulative side of things, hey, for the first 5 months, give us roughly 200, which, comes out to about 40 a month. So that's what we need in order to stay true to population increases using a 26-year historical metric. We need 200. Now, we got 493 in 2021, so we were on the surplus. That's why rents crashed 20%. 456 surplus, rent crashed. 296 still surplus. And now we're entering our third year worth of deficit, but look at the deficit of 2026. Well, what are we doing here? We are borrowing. We are making up this gap by absorbing this inventory from 2023, 22, 21, 2020. That's what's happening. What is the minimum number of unit criteria in multifamily? 5 plus. Yeah, so 5+ unit is multifamily. It could be 5, it could be 5,000. The permitting office defines multifamily as 5+ units. I kind of wish they had more. It's like, hey, let's about like 100 and more. Like, I'm always curious, like, how many apartment complexes out there with like 50 or, but no, it's just 5+. So we are already entering the phase of lack of supply going into 2028, 29, 30. That's what we're entering the phase of. So, which is just normal market cycle. So far, 52.4% of all active listings have had at least one price drop. We are down 1.9% year over year on active listings. On the pending side of things, double digit, you all. Double digit. We're up 10.2% on pendings year over year, which is amazing. Really awesome. We have 4,897 pending properties. This same date last year, 4,443. So we're up 4.6% on cumulative pendings. You add every single thing that went pending January through June, we're up 4.6%, which is really great. Activity index. We all knew that we hit 2 peaks on the activity index mid-March, early May, and then it's going to be all downhill from here. Last time the activity index bottomed out towards the last week of October, first week of November, and we are now this purple line trending down, but we're still up 9.8% on the activity index. For newer agents here at Team Price, you've got to memorize the activity index formula. This will tell you everything about the competitive nature of a neighborhood that you are representing buyers or a neighborhood that you are about to list a property. The activity index is very simple. It is pending divided by active plus pending. Pending divided by active plus pending. And it is one of the best leading market indicators available. Out of everything that could be under contract, what currently is under contract? Anything less than 15% is going to be a cooler market. Anything less than 10% is going to be a cold market. Over 25% is going to be a healthy market. 25% is going to give you that balanced market. Anything over 50% is going to be a great market. Anything over 75% is going to be an extremely hot market. And anything at 100% means there are no active homes. Everything that could be under contract is under contract. So when you look at the top 30 cities that we track and the top 75 zip codes, we've got all the properties that fit the expansion, equilibrium, softening, the danger zone. You start getting under 20%, you enter the danger zone, and then the crisis zone, it's going to be anything under 15%. And that's going to be that cooler market. And it's going to indicate a slower pace market, more supply than demand. Buyers are going to have more bargaining power. Sellers have to be more competitive on pricing. And we can see that we no longer have a single city over that 25% equilibrium/expansion. On the zip code, we do have 6 zip codes on the expansion and 7 on the equilibrium. Austin is now at 19.93. Keep in mind that this is only for resale properties. When you go to Activity Index Resource on Insight and Statistics, we have this for everything new construction and resale. But this is the Austin Daily Briefing, and I just like keeping the resale information here. As of now, we have, let me go to a different one. Let me go to this one. Give me 1 second, and let's talk about months of inventory. Months of inventory, we're down 5% year over year. And Cedar Park continues to win the race at only 2.9 months of inventory, followed by Pflugerville at 3.86, Round Rock at 3.99, Austin at 4.93, and 3.9. I mean, 3.9 is just killing it. 3.9 is doing great. When you look at months of inventory year over year, 40% have more inventory than this exact month last year. 60% less inventory. When you look at 2 years ago, we have 80% more inventory, 20% less inventory compared to 2 years ago. We do have this resource available for zip codes also in the months of inventory resource on Insights. We are expecting roughly 2,700, 2,800 properties will close this month. That is going to put us at a gain of 3.2%. When you adjust that for realtors, it's a gain of 8.8%. So that's really encouraging for us. Pricing, unbelievable. The average sold price is up 6.3% month over month. The median sold price is up a staggering 7.5% month over month. Now, look at the sold to list price ratio, 97.57. Under the past 2 months. What does that tell us? These numbers are going to go down. Don't be too attached to these numbers. We're going to have a lot of closings that will close. Agents that will I've got a closing. I've got my Sunfield property that closed on Thursday. I'm breaking the rules here. I've got 24 hours to change my listing to sold. I haven't had time. I haven't had a chance to do that. So I'm going to have to do that today. So I'm one of those rule breakers this time around. And it didn't sell for list price, and it sold for, $405,000? I think it sold for $405,000. Well, what do you think is going to happen to the average price and the median price when I put that property sold? Well, it's going to drive it down by a tad. Multiply that by 200 properties that get labeled as sold. That's why the average and the median is going to go down. But so far, man, rocket ship. 3 years in a row, year over year, average sold price is up. It's going to continue to go up. June historically is a positive month, so it's going to be positive. On the median side of things, let me go to the median for you. Look at that. Straight up. Straight up. Now, when you compare the median sold price to 36 months ago, we are down 2.25%. And what is driving that? Look at the top 25th percentile, up 9.2% year over year. The top 25th percentile, the demand on that price point is sky high. And I'm telling you all, there's a lot of people asking me questions about the Austin market. Spent a lot of time with people asking me questions. I had 2 conversations this past weekend/week when I was up in Toronto. One of them from Dallas. Hey, Dan, I've got a client moving to the Austin area. I want to connect the 2 of you. Another one's like, I got to get out of California. My state income tax is killing me, 13.5%. Like, there's just no way. So looking at different areas, what about Nevada? What about, Arizona? What about possible Texas? Maybe Florida. So what's happening is that we're noticing some states that are really leaning all in on the wealth tax, on A tax based on unrealized gains. You know what that means? Unrealized gains. So you've got capital gains that you buy something for 100, you sell it for 200, your gain is 100. Okay, tax me 25% on that gain of 100. That's a realized gain. That's a capital gain tax. What some municipalities or even states are proposing, and it will pass. It will pass. And didn't the Netherlands pass a tax on unrealized gain? Unrealized gain Netherlands tax? I believe they did. Yes, they did. We've got, conflicting news here. Conflicting news. It's hard to know who to believe because right here, as you Google this, you're like, oh, they may reconsider it. Okay, I found the article on LinkedIn, a highly trustworthy news source. So, the Dutch government adopted, for now, this is 4 months ago, a future 36% tax on unrealized gains. And we're getting memed to, I don't know what that word means. I have no idea. Rightly so. All right, so this is what this means. Okay, so you buy something for 100, you sell it for 200. You don't sell it. You buy something for 100, it's now worth 200. They're like, yeah, we're going to tax you on the unrealized gains. Now, I just threw 100, 200 for the sake of math. I don't know where this starts. I don't know where this stops. I'm not in the Netherlands, so I have no idea. Maybe it starts at like $1 billion. Maybe it starts at 100,000. I have no idea. Like, you do your research on that. Go ask AI. It's going to be truthful all the time, I hear. So they're like, yeah, you're going to have to sell your stock to pay for the tax on the unrealized gain. And New York is proposing unrealized gains. That's exactly what I heard in California also. New York, unrealized gain tax. Unrealized gains. New York has no unrealized gains. But what New York did pass, and the Board of Rent Control passed a zero rent hike for the next 2 years. Zero rent hike. Now, one thing that you don't realize, I certainly didn't realize that about New York, is that when a property has to get released, you have to bring it up to modern day code. So what's happening right now is that some landlords are like, this property's been leased for 10 years. I now have to put $100,000 into it to then lease it for exactly the same amount, which means I'll basically lose money forever. Like, I just won't release it. Like, I'll actually I'll just hold on to the asset and I'll borrow against the collateral, but I just won't lease it. So over the past 2 years, there's 50,000 units that were taken off the market because it's forget profitable. Like, you're losing money by renting the place out. So that's happening to New York. But the one thing that they did talk about in New York was taxing the asset if you don't live there, right? That's like the $100 million property. Like, let's just tax that asset X amount of percentage. But bottom line is this, right? Whether you're for it or against it, that's your deal. How is this going to affect Austin? How is this going to affect the 25th percentile? Yeah, it's going to have a higher demand on this. When you live in an area that does not have income tax, that's going to prop up that area, right? Because you've got someone that's saying, well, I don't want to be taxed on unrealized gains. Like, that's just not something that I'm interested in doing. Well, they're going to look at alternatives. They're going to look somewhere else. If you live in the Netherlands, you don't have an option, right? I live in the Netherlands. What am I going to do? Move? Well, in America, you've got an option. You can just go to a state that doesn't tax as much. So there is a dynamic recalibration that's happening just on demographics and migration between states simply based on tax policy. And Austin is being a beneficiary of that within the top 25th percentile, no doubt. And let's just see here. We've got Cedar Park, Del Valle, Hutto, Jarrow, Kyle not doing well. Cedar Park down 7.9. Oh, I got to fix that driftwood. That means it's over $1 million. Dripping Springs down. Hutto down 10.3, down 12. Hutto, big change in Hutto. Look at that. Hutto's getting affordable. I'll say that much. Kyle, I mean, it was really a miracle I sold that Sunfield property with the price I did. I mean, my client's super happy. So the 25th percentile overall is doing very well. When you look at the median sold price, we've got 8 cities that are up. Austin is now officially up 0.2% year over year. There are 2.8 sellers per buyer within our entire market. 0 cities are labeled as hot, 4 are warm, 19 are balanced, 6 are cool, and 1 is cold. On the zip code side of things, we've got 6 zip codes that are hot, 15 warm, 36 balanced, 15 cool, and 3 cold. We did update the absorption rate. We have been 4 weeks in a row, or months. We've been 3 months in a row. 3 months in a row where the absorption ratio sold divided by active was higher than the previous year. We're currently at 15.5%. Last year we were at 18.1. We're just going to have to wait and see if we improve that absorption ratio based on the number of closings that we have. And then finally, this is your market flow score. This is going to be your 0 to 10. How's the market? 10, the market's on fire. It's hot. Just list it. It'll sell. Don't even have to take a picture. 0, it's you're going broke. You already are broke. You might not know you're broke, but you're going to starve to death. You're going to be homeless. We only had 1 month of 0. That was January 2009. Last month, we're at 5.64. We absolutely crushed May of 2025. Same thing for April. Same thing for March. Same thing for February. So here's our 4 months in a row where our market flow score exceeded last year. What we have to do is keep on updating all of our data and all of our stats to hope that this number will exceed that number. It's looking iffy. It's looking really, really weak right now at 3.73. It's looking really weak. Let's call it like it is. We've had a little bit more new listings entering the market. But then pricing also has a factor, a little bit higher pricing, but that does eat into affordability. So we're just going to have to keep on updating this information. Our hope and our goal, not that we can change this, is that this number actually exceeds. Therefore, we have over 4 months of an improvement year over year. And statistically, that does mean that the market is in recovery mode. I have called the market in recovery mode back in March. We did notice a little bit of a pullback on the recovery because more listings are entering the market. Ratio is slightly struggling to beat last year, but that's like going 75 miles an hour and then slowing down to 73. Not a big deal. We're no longer in the phase where we're going 100 miles an hour and all of a sudden we're going 40. That's gone. That phase is gone. We're now more of like, we're bouncing between 73 and 77. That's where the market is. I'm fine with that. And you all, that is all I have for our Monday morning touch point. I want to remind you all that under market update, we have all of this information here. Same thing with insight and statistics. We also have the Awesome Metrics app that you can use both on iOS and on Google Play, where you can get all of this information updated daily. We do have our Wednesday training. A few of you are asking about the contract proficiency, and we're going to review the contract again on Wednesday over Zoom. And then we're going to start the contract proficiency with the new contract. But please join us on Wednesday. We do have a contract proficiency broker Q&A on Wednesday over Zoom. And then we do not have a Friday meeting because we're all going to be celebrating the 250th birthday of America. And that's all I have, you all. So, thank you all so much. Super appreciate it. And be sure to join us on Wednesday for our Wednesday training. And what's a good song to finish the meeting? Something that celebrates our 250th birthday. I know I found